This is FRM Part 1, Book 1, Foundations of Risk Management, and this is Chapter 5, in which we're going to continue to discuss risk management and some governance issues, but we're also going to try to focus on banks, because banks have an interesting balance sheet and interesting operations that are unique to that particular industry. So let's look at the learning objectives. All right, so what we're going to be able to do after completing this reading is to not only identify, but to determine the optimal level of risk exposure. We're going to be able to decide if a bank has too little or too much risk and what those implications are. We're going to look at how risk management can either add or destroy value for a bank, structural challenges and limitations to effective risk management, including the use of value at risk. And then we'll look at the bank's governance and incentive structure. All right, so let's start with methods banks can use to determine their optimal level of risk exposure. Now, you guys have seen me do this in previous videos, that many decisions can be boiled down to comparing marginal costs and marginal benefits. And that's really a good foundation to explain this idea of an optimal level of risk exposure. There are benefits of taking lots of risk, but there are also costs of taking lots of risk. And so remember, I say this in every video, what's the goal? To identify risk and measure the risk and then manage the risk. And so trying to determine that optimal level, once we have the risks identified and measured, then part of the management of the risk is to determine how much risk we actually want. So here's a good question to start off with. Is it possible to totally avoid risk in business? I mean, of course, there's no possible way that you can generate any type of a return in excess of the risk-free return without taking any risks. All right, so what's the deal here? I always love to ask my students this, especially in the context of publicly held corporations. And I give the example of either Sam Walton or Milton Hershey, and I say, look, when these corporate leaders, when these founders wake up in the morning, do they say, hey, I want to take lots of risk today, or I want to take a little bit of risk today? And in answering that question, of course, the goal of the business is to maximize shareholder wealth. So the executives and the founders in this case have to look at the shareholders and say, what do you men and women want? Do you want high risk? Do you want low risk? And when I ask this question to my students, they almost always say, we prefer low risk projects. And so then I give them the example of Milton Hershey. Do you want Milton Hershey to wake up and make tons of Hershey Kisses and Hershey bars? I mean, think about what that product line, it's in the mature phase, so there's not lots and lots of growth there. That's low risk. How are you going to buy low and sell high if we're taking just a slight amount of risk? Part of the goal of the business is, of course, to develop brand product lines. That's the Hershey Kiss. But the other part is to do some offshooting of those branded product lines so that you can take more risk to generate a risk-adjusted return that's going to satisfy the shareholders. That's why Milton Hershey years ago decided to make some licorice and to make some breath mints. Those were high-risk projects. So here I've got two things, marginal costs and marginal benefits. So low risk projects are going to generate a low return, which is not going to make the shareholders and the investors happy or satisfied. And then there's the idea about the manager's job security. High risk projects, on the other hand, is that we're going to generate a high expected return. And this is satisfactory to shareholders because remember, they're trying to capture the right end tail of the distribution. Now, the risk of loss is high, again threatening the manager's job. So we've got this employment marginal cost, marginal benefit going on, but we also have the obligation to generate returns to the shareholders. And so how do you solve this problem? Well, you try to figure out what's the optimal level of risk. And that's the risk that maximizes the value for the firm. Of course, goal of the business, maximize shareholder wealth. We need to take the optimal amount of risk. But here's a really simple illustration. We've got levels of risk going along the horizontal axis, and you can think of that in terms of a debt equity ratio or a debt to asset ratio, some measure of leverage inside of the business. And then on the vertical axis, we have some measure of value. That's probably market value. Maybe we'll go to the Modigliani and Miller market value, add the value of the equity and the value of the bonds. And so notice what's going on there with zero level of risk. You've got zero value, but as you take risk, you increase the value because you're investing in positive net present value projects. But then at some point you get over leveraged and the cash flows are not able to keep up with the debt service payments. And so there's that downward slope. So this is a classic calculus and a classic economic example of, hey, it looks obvious that there's the best point on that graph. Where do we want to be? We want to be at the optimal level of risk. Now, what does this mean in terms of achieving a specific credit rating? It might be that attaining the highest possible credit rating or the lowest probability of default, those have high correlations there, is probably not always going to be part of, or at least the number one goal of firms. Remember, we're down in the United States to just a handful of companies who have that AAA rating. So the overwhelming majority of firms out there have something less than AAA. But to earn that AAA rating, the firm either has to have tons and tons of operating cash flows and probably tons of free cash flows, and then they're probably going to forego risky projects, even if those projects have positive net present value. Because taking on those higher risk projects is going to increase the probability of default. Now, pursuit of the best credit rating or the highest possible credit rating brings in the specter of these opportunity costs. And the opportunity costs specifically are foregoing those positive net present value projects that have higher expected cash flows, but of course have higher risk levels. Maybe they have higher volatilities. So, of course, that final bullet point, there's a need to strike a balance between risk and return. And that's pretty much what we're doing there, even though we have value on the vertical axis there. Striking a balance between risk and return. Now, let's go ahead and put the specific credit rating on the horizontal axis, and then we'll keep value on the vertical axis. What are we doing here? We're comparing a AA rated bank and a BB rated bank. And that credit rating for the risky bank obviously is less than the credit rating for the safer bank. And that risky bank might have less value than the safe bank. Getting back to that idea of should every firm strive to have a AAA rating? And the answer is probably not. But what the second element of this discussion includes is finding an acceptable level of risk, an acceptable measured risk, an acceptable credit rating. And then finding projects that are consistent with that level of risk while protecting the bank from potentially crippling losses. Oh, how about sensitivity and scenario analysis? I love this kind of a discussion. Think about a project that has cash flows for a couple of years, and we typically determine the net present value based on the most expected or the highest probability of those cash flows occurring. And so when we calculate that net present value, it's an expected value. Now, what sensitivity analysis and scenario analysis does is the following. So I want you to think of an Excel spreadsheet with the computation of, let's just say, operating cash flows over a 3-year period. So you have years 1, 2, and 3 going across, and then you start with revenues and then expenses and then depreciation and then taxes, whatever you want to put in there to calculate operating cash flows, however detailed you want it to be. So you have the most likely operating cash flows at the bottom, and then you can compute the net present value. Well, what sensitivity and scenario analysis allows a financial risk manager to do is change one or groups of those variables and then recalculates the net present value. So you get a range of net present values. Think of it this way. You get a worst case scenario, you get a best case scenario. And think about the value that adds to the understanding of the risk management principles that we've been talking about in the previous 4 chapters. Here's the goal: to establish an impact of some specified shock on the financial stability of the institution. So when you do this sensitivity analysis, you're clearly aware of good things that can happen, but you want to focus on what happens if bad things or really bad things happen to the bank. For example, how about a sudden increase in interest rates by 500 basis points? What would that do to the asset side of the balance sheet? What would that do to the liability side of the balance sheet for the bank? And so not only can you do this in a cash flow framework like I described just a few minutes ago, but you can also do it in a balance sheet framework and really any other kind of a framework. And if you have really, really cool software, you can do Monte Carlo simulations. There's all sorts of stuff that you can do so that you can generate literally tens of thousands of possible outcomes. So when something happens, whether it's good or bad, the financial risk manager can go back and say, wait a minute, let me get out my spreadsheet. I'm going over here, I'm going down here. Oh yeah, this is exactly what I predicted under these circumstances. So what the financial risk manager and the bank is going to do is use all that information to take on projects whose expected and unexpected losses can withstand that shock. So note the final bullet point, I've got lots of different scenario analyses that includes things like, inflation or changes in currencies or individual countries' growth rates or any number of industry-specific or firm-specific variables that will help the financial risk manager better understand, trying to determine, hold on a second, let me go back here, trying to find that optimal level of risk. Here's a good illustration of this, of these types of analyses. So we have the initial asset position and an initial liability position on the balance sheet, and we have some shock. So we predict what's going to happen to the assets, predict what's going to happen to the liabilities. And by the way, hedging is going to play a big role in here. If we're a financial institution, we need to know the duration of the assets and the duration of the liabilities. So some kind of dynamic hedging strategy is going to help us find projects that have the associated expected return with the given level of risk, plus a consideration of these types of shocks. Risk management can add value under many circumstances. Oh my gosh, look at this. What did I say? Benefits of risk management outweigh the costs. So there's marginal costs and marginal benefits. And don't forget, you've got to do these in present value terms. Banks that adopt a flexible risk management process. So think about what that means. It's not a line of bricks that says when something happens, here's our brick, this is what we have to do. But it's rather, maybe something that goes like this, wavy, so that we can evaluate and we can dynamically alter the decision making to reflect changes in risk or changes in expected return. So the flexibility allows banks to identify profitable risks. All business lines are going to take this holistic approach to risk management. I emphasized that in the previous chapter. Remember, the holistic approach is kind of like a comprehensive plan in which decisions are not made independent of each other. There's that last circle under the final bullet point, requiring all business lines to take the perspective of the entire bank while making risky investment decisions. Risk management can destroy value if incremental risks brings about insignificant changes in bank's value. So that's why we do these things at the margin. We want to know what the marginal costs and marginal benefits are, so that if we take on a little bit more risk, then we get some kind of extra compensation. If the bank has inflexible, think of my bricks, and then managing in silos. Remember in the last video, I gave the example of a farmer having the silo for the corn and the silo for the wheat. And so the farmer has to manage the risk of agriculture based on both of those things and how they depend on each other rather than doing them individually. Now, of course, there are lots of times when a business and a bank is perfectly willing to accept risk, but lots of times it wants to transfer risk. And so derivative securities and insurance contracts are great vehicles to hedge. Sometimes, and it's a rare occurrence, you can affect what's known as a perfect hedge, where you can lock into the future value of a commodity, let's say. But lots of times, especially for financial institutions, real-time hedging does not really exist. And so there's going to be an opportunity in which is the potential for losses between the initiation of a transaction, maybe extending a mortgage loan, and then the acquisition of the hedge. Some risks are impossible to hedge, the risk of terrorism and the risk of weather, although I've said this to you guys before, there are weather-related derivative contracts. Yeah, remember I said just a minute ago that sometimes, rarely, you can get a perfect hedge, and so sometimes, most of the time, it's an imperfect hedge. An imperfect hedge occurs in two scenarios. The first scenario is when the two assets don't match. Remember, when you're hedging, you have a position in the spot market, and then you hedge in the derivatives market. If the assets of those two don't match, then you can't get a perfect hedge. The example that I like to use to my students: suppose you're an apple farmer and there are no apple futures contracts on the exchange, but there are peach futures contracts on the exchange. You can substitute a peach futures contract for your apple commodity price risk. Clearly, apples and peaches are not the same thing, so it's going to be an imperfect hedge. And the second component is the timing of it. You know, the duration on the right-hand side of the balance sheet for a financial institution might be, 2 or 3 or 5 years, but there might not be a derivative that has 2 or 3 or 5 years worth of a maturity. All right, how about risk-taker incentive limitations? Risk takers within the bank may increasingly take on excessive risks so that those individuals can be more highly compensated sometime in the future. Now, the next chapter, we're going to talk about some financial disasters, and we'll mention some of these things. If compensation is tied to the risk and return, it might provide incentives for individuals inside of a financial institution to take more risk. Ideally, the risk management function should be independent of any undue influence from the investment department. Now, this risk management department is almost like an internal watchdog, but the most important part of this internal watchdog function is the dialogue between the risk managers. And remember, the risk managers are doing things like sensitivity and scenario analysis, value at risk, examining betas and standard deviations from a holistic and a global standpoint. And then they have to communicate all of this information to the business line managers who may be operating inside of one of those silos. So communication is extremely important. Now, look at that last circle there. These unit managers may withhold critical information so that their silo might look better than it actually does. And then this, of course, prevents that loop from the beginning to the end of the risk management principles from being effective or complete. How about limitations of value at risk? And typically, value at risk is done at either 99 or 95 or 90% confidence. And let me just give you a quick example that we might, suppose we have a $100 portfolio, we might say something like, there's a 99% chance that the portfolio at the end of the period, maybe that period is a week, maybe that period is a month, maybe that period is a quarter, there's a 99% chance that the value of the portfolio will be worth at least $97.50 or something like that. So that value at risk, that $2.50 is the value that's at risk. And so the appetite of the individual, or in this case, the institution, says something like, okay, I can withstand that. I can handle that. I only have a 1% chance of losing $2.5 million or more. And so that's one of the limitations of value at risk. It does not measure the worst case loss. It makes some assumptions about distributions. Whenever you use standard deviation as a risk measure, you're almost, not necessarily, but you're almost giving into the assumption that the underlying distribution is normal. It doesn't have to be, but you're almost always saying that it's normal. And one of the assumptions in value at risk is that the distributions of losses are not correlated over time, and this is not correct. And of course, we can go back 10 years ago or so to see that, one day losses, when everyone feels so bad, it's not like they're going to wake up the next day and feel really, really good and have some kind of a bounce. And so losses can trigger more losses. So that should make sense that there's some correlation there. And then remember, there are bunches of ways to compute value at risk. You can use an historical method, and you can use Monte Carlo. I mean, I love Monte Carlo simulations, but the models have different inputs, and so they're going to have different outputs. All right, what happens if a bank takes too little or too much risk compared to its optimal level? So I'm not going to swing back to that earlier slide, but you have the hump there. So what happens if they're a little bit on the right or a little bit on the left? If a bank takes on too little risk, it's foregoing positive net present value projects. If it takes on too much risk, it's going to have a heavily weighted investment portfolio with high-risk projects. And if you have lots of high-risk projects, sooner or later, one of those projects is going to have devastating losses. How about a potential impact on a bank's governance, incentive structure, and risk structure? Now, the bank's governance, it's difficult to kind of figure out its direct impact on profile and performance, mostly because there's limited data on how the risk function operates in banks. And remember that each bank is going to have its own risk appetite based on the personalities and experiences of the board of directors. Remember that banks can record extremely poor performance, negative operating cash flows, negative income, declining asset values on the balance sheet, even when it has strong governance principles. The incentive structure is also a vital ingredient in risk management. And so you should reward managers who take the appropriate and the relevant risks to create value, and that's important. And if the managers don't, then they ought to be penalized for it. Now, there are a couple of studies to try to assess the impact of culture on risk management. One interesting study shows that when managers are perceived as possessing characteristics that are altruistic, like being honest and being trustworthy and making certain that they're aligning the corporate goals with the goals of the owners, then the firm is more profitable. On the other hand, there's a study that shows that improvements in shareholder governance principles can change a firm's culture it can change it away from integrity and customer experience and emphasize shareholder wealth maximization as measured solely by things like net income and operating cash flows. And so you see the sense of the results of these studies that, boy, it's best if we look at this thing from a holistic standpoint, from a global standpoint. Remember the umbrella that covers all of those different kinds of risks from Chapter 4. If we approach risk management from that perspective, including the interest of the shareholders and the other stakeholders, coupled with excellent leadership from the board of directors, it's probably a greater likelihood that firms are going to be able to find that optimal point on that graph that we talked about early in this slide deck. So there's a recap of those learning objectives. Looks to me like we covered each one of those. Next up is discussion on financial disasters.